a bear market, we often focus mostly on the blue chip stocks as they tend to be the safest bet. However, there are some small cap stocks out there that are so far weathering the sea of red very well. Today, we will look at some of these small cap potential recession busters, and we'll begin right now. A small cap stock is defined entirely on its market capitalization. It ranges from $300 million all the way up to $2 billion. It would be incorrect to call these penny stocks, though some of them are. For this video, I looked for small cap stocks that have a positive return on investment thus far and have some basic good fundamentals. This should be a given if they are still in the green. Before the small caps take center stage, I want you guys to hit the comments and tell me if you have any small cap stocks currently in your portfolio. Also, if you are new to the channel or those folks who watches all the time but hasn't yet subscribed, yes, I am talking to you, Angela. Please click on the subscribe button. It's absolutely free and it helps me bring more content to you. When I began the research for this video, I was honestly thinking I was only going to find small cap energy stocks. Oil has been on fire this year, though in the last month the wind has petered out of their sails a wee bit. I do not believe that oil is done yet, but I do think the time for crazy profits has passed with oil. I have downsized oil in my portfolio as I was overpositioned while it was pumping. I will still hold a full position though, as oil is still a great long-term hold, and there are still chances for more action depending on, well, world events. With that all being said, there are of course some energy stocks in the list. And starting off the list at number 7 is Verdi Artitech with a ticker of NPK. They are an agriculture tech company that produces solutions for crop nutrition and protection, soil improvements, and sustainability. One of their biggest products, Super Green Sand, is available worldwide as a soil microbiome improvement option. With the food issues and fertilizer shortages caused from the war in Ukraine, this is a company positioned well to fill some of those gaps. They have a market cap of $347 million, and at the time of recording, their share price was a spooky $6.66. Not a bad entry point. They have a fantastic beta of 0.55, which makes them almost half as volatile as your average stock. They have a positive earnings per share, which comes in at 0.16, and their price to earnings ratio is 41.40. These guys are not a dividend stock. So let's take a look at their return on investment. Their 1-year ROI is a holy banana bread 601%. They were a penny stock a year ago with a share price of 95 cents. But let's take a quick look at that 6-month ROI, as I think that will give us a better indication of how they are doing in 2022. The 6-month ROI is 143%. This also looks pretty amazing. What that does not show, though, is that the stock did peak at $10.74 in April, so there has been a slide of 61% over the last 2 months. So what does this all mean? This is a very interesting stock, and I can see potential for some big growth, but I would not bet the farm on them. I would still approach this one with a good hefty dose of caution. If you want to throw some caution to the wind funds on it, that is not a bad choice for that. Up next, we have our first energy stock, and it is Spartan Delta Corp with a ticker of SDE. They are a gas exploration and development company that operates out of the Peace River Arch in Alberta. They have a market cap of $1.82 billion, so they are almost mid-cap. Their shares are priced at $11.74. Their beta is 2.59, so they are pretty volatile, which may make them a possible candidate for swing trading. They have a positive earnings per share, which comes in at 2.47, and their price to earnings ratio is 4.80. They're also not a dividend stock. Their 1-year ROI is 113%. The last 6-month ROI is 81%. Not too shabby at all, if you ask me. They did peak at $16.03 in early June and have thus experienced a 36% drop in the last month, like much of the energy sector. With this stock, the increased volatility has helped us see a larger drop than the average oil sector drop over the last month. This, of course, could be an opportunity when oil rebounds. So something just to keep in mind. Maybe it is something worth watching, but nonetheless, a caution prospect for sure. And at our number 5 spot, we have Vimid Healthcare with a ticker of VMD. They are a provider of healthcare equipment within the areas of respiratory disease, oxygen supplementation, sleep apnea, and PAP treatment. They are on both the TSX and the New York Stock Exchange, and they do have a strong presence in North America. They have a market cap of $325 million. Their shares are priced at $8.46, so very affordable. Their beta is 0.76, so they are pretty non-volatile for the most part. They have an EPS of 0.29, and their price to earnings ratio is 29.30. Like everyone we've seen so far, they also do not have dividends. Their 1-year ROI is 4.8%, which is not very, well, it's not very impressive. The last 6-month ROI is a bit better at 25%. They are actually unusual in that they are peaking now and have been growing consistently through the bear market. So with this stock, we do have to keep in mind that they are peaking, and that makes me ask if they have any gas left in the engine. They may, and they are probably worth watching as we move deeper into a bear market. Could this be a good long-term play? Only time will tell, and I will, of course, be interested to see what happens next in this stock's price action. Up next, we have Uniselect Inc. with a ticker of UNS. They are a distributor of automotive products and paint with their hands in the Canadian, American, and UK markets. With a crashing economy, people are going to put off buying new cars, and this could be a boom for companies in the aftermarket parts sector as people will need to fix their current car as they put off buying those new ones. So, they have a market cap of $1.4 billion. Their shares are priced at 32.22. Their beta is a little high at 1.78. They do have an EPS of 0.24, and their PE ratio is 135.50. That is a wee bit more than a wee bit high. And continuing the trend, they do not have any dividends. Their 1-year ROI is 122%, which is definitely pretty good. The last 6-month ROI is 55%. They peaked at 32.74, so they have not really been hurt thus far by the bear market. With this one, the really high PE ratio is concerning, as it usually can indicate that they are overvalued. However, it could also be a result of their massive growth over the last year. This is absolutely one for my watch list, and a little caution is, of course, never bad. Up next, we have IBI Group with a ticker of IBG. They are an engineering services provider that provides intelligence, buildings, and infrastructure business streams. This includes various services including architecture, engineering, interiors, landscape architecture, planning, and urban design. They have a market cap of $468 million, and their shares are priced at $15 at the time of recording. Their beta is a pretty average 1.09. They have an EPS of 0.77, and their PE ratio is 19.50. And playing a broken record, they also have no dividends. Their 1-year ROI is 47%, which is great. The last 6-month ROI is 13.2%. They are currently at their peak and have done very well in the bear market after recovering from a little bit of a 37% drop at the end of April. This one is definitely a tricky one because their success could entirely rely on the demands of the overall construction market. So far, they seem pretty resilient, but that could change. They will no doubt survive the recession, but the degree at which they thrive is definitely, well, it's uncertain. And for that reason, a moderate to high level of caution should come with this pick. Up next, we have our first dividend payer of the day, and they are Freehold Royalties with a ticker of FRU. This company is sort of in the energy sector as they manage and acquire oil and gas royalties. The companies they receive royalties from are in both Canada and the US. This is going to be a solid play. Based on the sector, and even with oil and gas coming down, it should not impact this company as much. They have a market cap of $1.9 billion. Their shares are priced at $13.09. Their beta comes in, well, it's pretty high at 2.29. They have an EPS of 0.74, and their PE ratio is 17.70. This company does have dividends with an impressive yield of 7.334%, which is paid out monthly in the amount of 8 cents per share. Their 1-year ROI is 39%, which, well, that alone is pretty good. The last 6-month ROI is 10.4%. They peaked at $16.65, so they have responded to the oil and gas downturn in the amount of about a 27% drop. This is not a bad stock for a long term, especially with the dividend payout. They are almost a mid-cap, And they are in a solid sector, so the caution for this one is lower for sure. Still, not as safe as a blue chip stock, but not one I would lose sleep over either. Our top company is Polaris Infrastructure with a ticker of PIF. They are in the energy sector, but not in oil and gas. They are involved in the exploration, development, and operation of geothermal and hydroelectric energy projects. One of their biggest geothermal projects is all the way down in Nicaragua. They have a market cap of $410 million. Their shares are priced at $20.94. Their beta is 0.91. They have an EPS of 0.25, and their PE ratio is 83.50. This company also has dividends with a yield of 3.732%, which is paid out quarterly in the amount of 15 cents USD per share. Keep in mind, if you have this in Wealthsimple, there will be a currency conversion fee. Their 1-year ROI is 13.6%, which is okay. The last 6-month ROI, though, is 31.3%. They are currently just shy from their peak price of $21.05, which shows that they've done well while oil and gas has stumbled. It does make sense that there is a higher demand for thermal and hydroelectric energy. And this is a company I would have no problem looking at for a longer term investment. I really do think they could have, a pretty bright future. Some of these companies have potential, and like I have said, many of them are worth watching to see if they can be that mythical recession buster. Maybe a few will do just that. It is still a safer choice to settle in for some long-term blue chip investing. Speaking of blue chips, you should check out my video on 7 blue chip stocks to hold forever, or you could try the video YouTube thinks you'll like. Your click will decide who's right, and I'll see you in the next video.